Lombard Odier liquidates its China assets to flee. The investment chief says recovery can't last. Under the strong stimulus policies of the Beijing authorities, the Chinese and Hong Kong stock markets have recently been excited and soaring. Michael Strohbach, chief investment officer of Lombard Odier, a Swiss company that resolutely sold all its Chinese assets, said that the current surge in A shares is only a temporary phenomenon caused by the stimulus policy and is difficult to sustain. Other analysts have also warned that technical indicators show Hong Kong stocks are overbought and investors should exercise caution. Last week, the Chinese government took a three-pronged approach to stimulate the economy. This included the People's Bank of China's announcement of a reserve requirement ratio cut, interest rate cuts, and reductions in existing mortgage rates, providing loans to investors, companies, and institutions repurchasing stocks, and a promise from a Politburo meeting to launch fiscal measures of an unspecified scale. First-tier cities such as Guangzhou, Shenzhen, and Shanghai immediately aligned with the central government's intentions, relaxing housing policies at the same time, driving the Chinese and Hong Kong stock markets to rise sharply for several days. On Monday, September 30th, the Shanghai Composite Index opened at 3,194.72 points, rising to close at 3,336.5 points, an increase of 8.06%, with a transaction amount reaching 1.17 trillion yuan. On September 30th, Hong Kong stocks also continued to rise. As of the close, the Hang Seng Index closed at 21,133.68 points, up 501.38 points, or 2.43%. The Hang Seng Technology Index closed at 4,751.81 points, up 6.7%. The State-Owned Enterprise Index closed at 7,509.79 points, up 2.88%, and the Red Chip Index closed at 4,042.52 points, up 1.95%. However, according to Bloomberg, the chief investment officer of Lombard Odier, renowned as the Swiss private banking model, said in an interview on September 27th, "I cleared all Chinese assets and transferred to U.S. stocks, U.S. Treasury bonds, and U.S. dollars. This investment decision has been very effective. I don't think the government's strong stimulus policy will have a lasting impact on the stock market or the economy," Strohbach said. "This is a short-term measure to boost some market confidence." He added, "Frankly, when the Beijing authorities intervene in the capital market in any specific way, I usually think it's not a good sign." After Strohbach took office as Lombard Odier's chief investment officer in November last year, his first major decision was to clear all the company's Chinese assets. He told Bloomberg that Lombard Odier's previous investment in China accounted for about 6% of its strategic asset allocation, but now it has dropped to zero. He emphasized that he will never regret it. Strohbach said the company has made substantial gains in the U.S. stock market this year. The next step will be to consider reducing investments in the U.S. stock market and turning to markets outside the United States, including emerging markets, but excluding China. Data shows that Lombard Odier Switzerland manages assets as high as 209 billion Swiss francs, most of which come from private clients, and its asset management department handles about 63 billion Swiss francs. Coincidentally, as the Hong Kong stock market has been soaring for several days, some Hong Kong analysts have warned investors that the current performance of Hong Kong stocks is no longer active trading, but rather in a hyperactive state. With technical indicators showing that Hong Kong stocks are seriously overbought and mainland China beginning its National Day holiday on Tuesday, market funds will stop flowing in, and Hong Kong stocks may face adjustments, so investors need to remain cautious. China's unemployment problem worsens. Young people go to the countryside to retire. Layoffs, resignations, and unemployment. China's employment situation continues to deteriorate, which is exhausting, and young people on the mainland are turning to the countryside to retire. China's Generation Z and millennials are increasingly sharing their retirement lives in the countryside on social media, saying they were laid off, resigned, or have no job at all. These self-proclaimed retirees, born in the 1990s or 2000s, have already started taking long vacations or are unemployed at a young age. According to CNBC, these young people usually choose to go to Yunnan, Guizhou, and Sichuan to be retirees because the cost of living in these provinces is only a quarter of that in Shanghai. Last year, Wenzi Dada, who calls himself a retiree, settled down in a bamboo shed on the edge of a cliff in Guizhou province. Wenzi, who was only 22 years old, had worked in many industries such as auto repair, construction, and manufacturing. He told local media that he was tired of dealing with machines every day, so he resigned and returned to his hometown. He tried to find a job there but was never satisfied. As time went by, Wenzi began to think about the meaning of life. He realized that life is not just about the prosperity of the city. The tranquility of the countryside is also a kind of beauty. Chung Chi-Nien, a chair professor at Hong Kong Polytechnic University, said that as China's economy struggles, it is particularly difficult for young people to find jobs. He explained that a record 11.8 million college graduates entered the labor market this year, and competition has intensified, causing the devaluation of university degrees. New graduates have few qualifications and little experience, which further reduces their employment opportunities. In August, China's youth unemployment rate hit a new high of 18.8%, climbing again from 17.1% in July. The latest data was released as China's economy showed a series of disappointing signals due to weak domestic demand and a sluggish real estate sector. High-value-added service industries that once absorbed many fresh graduates have shrunk significantly in the past 3 years, particularly real estate and finance, said Dan Wang, chief economist for China at Hang Seng Bank in Hong Kong. Although there are some low-paying jobs in the city, such as delivery or ride-hailing, educated young people are unwilling to take such jobs. Kyu Jin, an associate professor of economics at the London School of Economics, noted that while there are job opportunities in manufacturing, young people are not interested in these positions. They would rather stay at home with their parents and wait for better jobs, she said. According to a research report published in June by China Higher Education Research, a journal under the Chinese Ministry of Education, the number of college graduates may peak at about 18 million in 2034. Zhou Yun, an assistant professor of sociology at the University of Michigan, told Reuters that, for many Chinese college graduates, a college degree brings better job prospects, higher social mobility, and brighter life prospects, which are becoming increasingly out of reach. New policies for the real estate market in Beijing, Shanghai, Guangzhou, and Shenzhen. Experts. Cutting leaks and deceiving people into falling into a trap. The Chinese Communist Party has recently issued a number of so-called financial policies to support the real estate market. Subsequently, the first-tier cities of Beijing, Shanghai, Guangzhou, and Shenzhen have also successively issued supporting measures. Can these tricks really resolve China's real estate crisis? Please see the report. Following the recent announcement of financial policies to support real estate by the Central Bank of the Communist Party of China and the State Administration of Financial Supervision, Beijing issued a notice on the so-called 8 new regulations to adjust real estate policies on September 30th. The notice stated that it would reduce the interest rate of existing mortgage loans, lower the minimum down payment ratio for personal housing loans, and cancel the standards for ordinary and non-ordinary housing, among other changes. These regulations will be implemented from October 1st. David Huang, an economist living in the United States, said, "It is to lower the threshold for buying a house. But the house payment has not been reduced, so it should be said that the government has not given up its real interests." Before Beijing, Guangzhou, Shenzhen, and Shanghai successively announced policies to rescue the real estate market. Among them, Guangzhou canceled the purchase restrictions for the entire city starting from September 30th, becoming the first city among the first-tier cities to completely withdraw from the purchase restriction policy. Analysts believe that these policies are not very beneficial to ordinary people. David Huang said, "The overall explanation is that people are still expected to solve the housing price problem. The government has lowered the threshold to allow more people to enter the market, but the housing prices they will have to bear in the future have not been fundamentally reduced. China's economy continues to deteriorate. The real estate sector has been hit hard, and unfinished buildings are everywhere, but the authorities have never released relevant data. According to a report by Nomura Securities, by the end of 2022, the number of unfinished pre-sold houses in China will be about 20 million. According to a Bloomberg industry research report, based on pre-sale data from 2015 to the first half of 2024, at least 48 million pre-sold houses in China have not been completed. The people are suffering. A Chinese resident said, "Now we have to pay 5,000 yuan in mortgage every month. If this unfinished building continues to rot, then for me personally, I really don't have the courage to live." Analysts believe that the policies introduced by the authorities are still aimed at cutting leaks, deceiving people into falling into a trap, and taking over the land finance that is in deep crisis. The real estate crisis remains difficult to resolve.